Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, May 13th. You know, one of these weeks I'm going to be able to come on here and say, we had an up week in the broad indices. Not this week. It's been now 6 weeks in a row of down negative action in the S&P. By the way, that's the longest string dating all the way back to 2011. That's a heck of a long run to go without this kind of negative activity. What did we see this week that we found interesting? Well, in terms of going back to last week's video, we're trying to spot which sectors are at least putting up a fight. Those are the areas we want to concentrate on going forward. Mentioned semis last week, mentioned transports. Not too bad this week. Showed a little bit of fight midweek when the market was selling off, and then had a lift today. I thought it was interesting to see overnight Ryder Transports getting a takeout offer. You know, one of the signs we start to look for in sectors, industries, are individual companies that have value. So you did see a private equity firm which had a position in Ryder offer a 20-25% premium to buy the company. In and of itself, just a one-off. But interesting that there is cash looking for deals, and you have to think with some of the destruction in these equity values that we'll see more of that. That can tend to help firm up the market. Longer term, and it's very difficult to think longer term. Everything's so short-term oriented through the media and social media and Twitter. But longer term, even through this pullback, I want to just pull up a chart here. It's called a dynamic asset level investing chart. I found it handy over the last 20-25 years to think of your longer term money and how you want it allocated. You can see commodities and domestic equities are the two asset classes you want to be concentrated on. Now in our tactical portfolio, we're primarily domestic equity with some commodity exposure through the equities. But we need to add to some of that commodity exposure. Thus far, I've been hopeful to get a little pullback. You can see how strong that energy complex is because it will only pull back for about 5 hours, you know, a day, maybe a day and a half, 2 days. The flip side of that strength in energy, in the barrel of oil, is the fact that we really need that oil to come down a little bit. We've been talking about the three kind of telltale signs we're looking at. One is interest rates. Well, the 10-year and the 30-year backed off this week. We don't need them to go down, by the way. But a 10-year trading in a range instead of a momentum move higher in yield is helpful. If we could sit in that 285 to 320 range, that would be helpful to the equity market. Second thing is oil. You know, again, even with the rally in equities today, oil, 110 West Texas crude, cannot get that broken. So that's a area that's a primary concern. Then the third is the dollar. You know, the dollar has been the only place of respite currency-wise. Very strong, and in terms of strength, not giving much back. So we'd like to see a little weakness in yields, a little weakness in crude, and a little weakness in the dollar to try to stabilize this equity market. Make no mistake, there are values being created. When equity markets especially are very strong, investors and traders are always focused on opportunity, not risk. When equity markets are very weak, traders, investors are always focused on risk and not opportunity. There will be opportunity here. It's being created daily. Be patient, keep an eye out for what's working, and we'll go back to the drawing board with trying to bid underneath the market for quality names. Let's toss it over to John Mousseau, who recorded his video earlier today.
Good afternoon, John Mousseau, CEO and Director of Fixed Income at Cumberland Advisors. It is Friday morning on May 13th, Friday the 13th. This week in bonds, we saw yields decline on Treasuries. Everything across the board, from the 2-year to the 30-year, 2 years down 12 bips to 252, 5 years down 18 bips to a 295, 10 years down 20 bips to a 293, and the 30 years even down to a 306, down 17 basis points. Why? With all the consternation going on, bonds are taking a little bit of a signal from stocks where the major indices are down for 6 weeks straight. It's starting to have an effect. You're starting to see people look at bonds more critically, particularly now that yields have risen. Remember, the 10-year bond at the beginning of the year was at 150, and now it's almost at 3%, and it actually crossed 3% last week before coming down. Muni yields still under pressure because they were up this week by about 8 to 10 basis points across the curve. That hasn't changed our outlook. We think municipal bonds at cheaper than 4% are an absolute giveaway. And clearly this week, if those yields are up and Treasury yields are down, then munis are even cheaper. What is another reason driving some of the bond yields down? We looked at the inflation numbers this week. Both CPI, Consumer Price Index, and PPI, the Producer Price Index, still high, but the month-over-month numbers were lower than last month. So for example, on the CPI, last month was 1.2, this month was 0.3, a little higher than expectations, but down. PPI, last month 1.4, this month 0.5%, down. We don't know if this is a trend, but it is clear to us that if we start to have months where inflation, though still elevated, is lower than the month before, then the trend is getting better. And there's lots of anecdotal signs of inflation starting to cool, whether you want to talk about trucker rates, whether you want to talk about shipping rates, whether you want to talk about the fact that a lot of homes do not have 20 offers for every house that comes on the market anymore. It's more like 5 or 6. All of this is leading us to think that inflation is starting to cool or has peaked. We will know more as we go down the road. Next week, pretty low-key week. We're going to be looking at University of Michigan's, inflation numbers. And we're also seeing on inflation what we call the break-even inflation rates that are priced into the Treasury markets. Those are also down under 3% for 5 and 10-year break-even rates. So the market's expectation of inflation is also starting to drop, which makes the muni bond at 4, which is a taxable equivalent of over 7 in many states, to be a real bargain in our view. We're very sorry we had such poor picks for the Kentucky Derby last week. As we know, the winner was an 80-to-1 shot. We're sorry we didn't know that, but we will look forward to the Preakness in a couple of weeks. Everybody have a good weekend.
Thanks, John. And Rich Strike is aptly named because that horse is the only thing striking it rich right now. It's been tough on us across the board in multiple asset classes. Don't forget to like, comment, and subscribe. Have a great weekend. We'll see you next week. I'm sure there'll be plenty of action.